I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. This certainly has been an interesting week to see what the Federal Reserve has done and how the markets have been moving as a result.
They've slapped the brakes on interest rate hikes, it seems, and maybe one hike next year. What does that tell us, and what's that doing to the markets?
Well, last year they raised rates 4 times, and in December they were predicting 2 rate hikes this year. But not only that, starting in 2017, Ben Bernanke launched a program to try to so-called normalize the balance sheet of the Fed. What happened was in 2008 and then in the years to follow, the Federal Reserve just bought all these bonds to bail out banks, then to finance the U.S. government deficit. And one effect of that was it drove down interest rates in the corporate bond market to a record low around 2013. And that fueled companies raising all this money in the junk bond market. They use that money to finance buybacks and so forth. But what's interesting is in 2017, they said, we're ending that program and we're going to let these bonds slowly expire to get the Federal Reserve balance sheet back to normal. And, last year, they actually, Chairman Powell basically asserted that they'd be doing this for years. Slowly, but they would accomplish normalization. Now, what happened this Wednesday is not only did the Federal Reserve said that they won't be able to raise rates anymore this year, they cited what they see as economic data that suggests that the economy is not going to grow as fast as they had expected, but they also said that they're going to end this normalization of the balance sheet in September. So there's multiple ways to read this, and various markets are reacting in different ways. So, for example, the bond market has rallied since yesterday, and the 10-year Treasury bond has plunged to a 12-month low, factoring in economic slowdown, a dovish Federal Reserve, which is obviously what we have now. It's a massive shift in Fed policy. Normally the Federal Reserve wouldn't get this dovish until the stock market fell, or the economy dramatically slowed down. Neither of these has happened yet. So this may be, in fact, one of the most dovish Federal Reserve events we have seen in our lifetime in the financial markets. But regardless, the 10-year Treasury bond yield collapsed today, down to about 2.5%. And we're getting very close to an inverted yield curve on the 2-year and 10-year bond. The spread is only, a tenth of a percent. And when that gets negative, it means 2-year bonds are yielding more than 10-year bonds. It's a sign of economic recession to come, a forecast that the Fed will be dramatically forced to lower interest rates. So we're on the path to having that happen now in the bond market. So that's an interesting development. And the Fed fund futures market is actually pricing in a 35% chance of an interest rate cut before the end of the year. Now, for a cut to happen would take a recession, or the stock market having another big decline like it did last year, big enough to scare the Fed into cutting interest rates. We saw that happen in January 2018 and January 2001, in which the Fed, it was in October, so late September 2007 is when the Fed started to lower rates. In that last cycle, and the cycle before that, it was January 2001. So, in other words, the Fed fund futures market is pricing in a 35% chance of the Fed being forced to dramatically lower rates like they did those last 2 years, which, was a wild time to say the least. But just put that in the back of your mind and the listeners too. 35% chance. That doesn't mean 100%, doesn't mean certainty, but 35% chance. That's a sign, though, that there are risks in the market. However, those risks are obviously being ignored as we're speaking because we're seeing a rally in the stock market. It was pausing for the past about 3 weeks. I was actually seeing signs of distribution. Some of the weaker stocks were starting to fade, which is a sign of potential top. But we actually ended up turning to break out to the upside. At the moment, we're probably going to see some stocks attack their 52-week highs. The NASDAQ momentum is shifting into there again. We'll see what we can do over the next couple of weeks. So everyone's kind of celebrating and rushing to buy these stocks. I think ignoring the 35% chance of something bad happening, probably in the fall or starting to happen. However, the leadership is still in defensive sectors. A lot of stocks that pay high yields, utilities, REITs, and so forth. They broke out today, went up pretty good, more than the market averages did. So I'm not really sure, how strong the stock market really is going to be over the course of the next couple months. I'm still skeptical that we're really going to do nothing but see the market go sideways. But even if that's the case, some of these leadership sectors should still do okay, especially these yielding ones, because people now, I think, are going to be chasing yield and desperate when the Fed basically is saying we're not raising rates, and the next big move might be cutting rates. So interest rate yielding stocks or something, I think we're going to see people throw more money into. And also the dollar dropped on this news, and gold got a bid yesterday. Gold stocks, some of them are having really great days today. Wheat and precious metals, for example, which for disclosure purposes, I'm going to say I own a position in it, but it was up 5% today. And many mining stocks are having nice runs, even though gold is still below that 1350, 1330 resistance zone. And I don't really believe it's going to break through it over the next couple of weeks. It may take a couple months for it to build a consolidation below that before it really breaks out. And, but I think, for an investment standpoint, everyone in the United States wants SPY. They want to buy these popular technology stocks, but I still believe that it's going to be gold, because not only is gold going up, or has been going up since October, with the mining stocks outperforming the S&P 500 and these popular fad technology stocks. Not only have they been doing that since October, but if the Fed is going to be more dovish and there's potential to lower rates in the future, gold's going to be what benefits the most in that type of environment, because it's going to really tear the dollar apart. So I really think that's the place to be, and for people to look for trades. The whole sector hasn't exploded yet. A lot of the small caps are still consolidating and going sideways, and probably won't really take off until gold goes through those resistance levels at that 1330 to 1350 zone.
We'll have more with Mike Swanson right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Mike Swanson. Mike, where does Brexit and the European markets play into all of this? They haven't raised interest rates there for, I think, a decade.
Well, I really don't know. And it's kind of the oddness of the financial markets, because here, you know, we seem to be in a countdown of some sort of turmoil for England, but the financial markets just completely are ignoring that. And when Brexit first was voted on in 2017, it caused the stock market, markets all over the world, to go down for 2 days, and they just bounced right back up and ignored it. I mean, you would think this is going to be a bad thing for England and the currency markets, at least cause some short-term turmoil, but it's being completely ignored. And there have been risk factors that the markets have ignored for quite some time. I mean, you know, the tariffs are an example of this too. The Trump tariffs, or the tariff war, whatever you want to call it, between Trump and China, that broke out last year, it only caused short-term drops, and really there's no sign of any resolution, of that situation, that there's going to be any deal at all. In fact, the odds of that have even diminished this week. I say this to compare it to the Brexit question, because, you know, there's no sign of resolution to that either, or it's even worse. And so far it hasn't mattered. And I think with all news events, the thing to do is to focus on the charts and the stocks and see if the trends meaningfully change. And, you know, we had the markets break down last year, 20% drop. They've had what I think is a bear market rally, but regardless, you know, the rally hasn't rolled over yet. So until that happens, I'm just kind of cautious to think that any one single news item is going to really derail everything. If something bad happens, you know, with the Brexit, then probably would kick the market down for a couple of days, maybe even a week or two, but then we'd have to see it bounce back up and then go from there. So I just treat this as 1 week at a time.
Well, with Brexit, I don't see why, if you have a business relationship between a company in Britain and Germany, why all of a sudden that personal relationship would be broken up, or if you're using a certain supplier, why would you change?
Yeah, I don't think you really would. And really, you would think, you know, if there's a large business conglomerate, that they would hedge the risk somehow. You know, you can do that too, with hedging currencies, and so forth. I mean, farmers do it all the time through the futures market, and so do gold companies, as we have spoken about much in the past. So I would think, you know, smart businesses would hedge, oil markets hedge. So I would hope that would be the case for most people.
Well, the booming market in Britain right now is the Brexit survival kit, you know, in case food supplies or whatever essentials are cut off somehow.
Well, I don't think it's going to be as dire as Venezuela is. And, you know, England has the pound. It's not like Greece trapped in the euro. So I really don't know. You know, I don't know what the actual impact, good or bad, would really be, especially on people living inside England. I'm not really sure.
Well, I mean, if they survived U-boats sinking half the food headed their way during the Second World War, I don't think they're putting the U-boats out again.
No, and, you know, I guess the biggest risk factor would be a drop in the value of the pound. And that's something that's happened in England before. I mean, it happened in the 1980s when George Soros, you know, famously shorted the pound, but it happened after World War II also. And, you know, I would say that's the real risk factor. Let's say the pound fell 10% in value. That would be disruptive to people, but you know, it's not going to cause electricity to turn off and currency moves and commodity moves. They can have disruptive impacts, but, you think about the United States in the 1970s with the, oil embargo that was launched on us by OPEC. That was a disruptive event, but, people survive and get by. So I just don't know, I don't really know how much of this is priced in already too. That's one thing about these markets, that they almost are becoming, in some ways, more confusing to figure out what's going on in all of them. For example, the stock market. I was talking about this 35% risk factor that the Fed would have to lower interest rates. That would cause the stock market drop for that to happen. And how much of the rally now is front running the possibility that the Fed would lower interest rates. It's very, especially the bond market. The corporate bond market is really been rallying, much faster than I would have ever thought, and seems to be front running, things that normally wouldn't occur, until the Fed does lower interest rates. So in these type of markets where, I admit, I can't figure out what's going on in every single one of them. What I try to do is stick to the ones that aren't as confusing, that make more sense at the moment. And frankly, the gold market to me makes complete sense, because it's rallied back up to that 1330 to 1350 zone. The gold stocks are doing good. However, you wouldn't really expect it to break out, until it becomes more certain that the Fed's going to be lowering interest rates, more certain than a 35% chance. And in that case, you would expect gold to go sideways and the better mining stocks to break out that have good earnings and good discoveries. And that seems to be the environment we're in. And I say that to say that's what I'm sticking with at the moment. In England and Brexit, I don't know what's going to happen,
I believe the official British plan is we'll muddle through it. We have through every other crisis in the past. Why would this one be any different? Somehow they make their way through it.
Well, that's the amazing thing. That certainly seems to be the political reaction in Parliament in May. They don't have a plan. They vote things down, and there's no clear resolution. They don't seem to be too worried about it.
We'll have more with Mike Swanson right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, does it seem more likely with so many candidates now in the U.S., at least on the Democratic side, saying they'd be in favor of national legal pot, that perhaps that's going to happen sooner than later?
Yeah, I think state by state we're starting to see, of course, cannabis and pot become legalized, but it's also becoming a Democratic issue. The Congress can also pass a bill. It doesn't even necessarily take one of these people winning the presidential election. And if Congress passes a bill, all it would take right now is a few Republicans, voting on their side. But let's assume, in 2020, just the way the, Senate races are stacked up, the Democrats have a good chance of taking the Senate, even if they lose the presidency. I definitely think a national bill for cannabis can happen. But even if it doesn't, slowly, state by state, it seems to be happening. The state I live in, which is the state of Virginia, there's now something new happening that hasn't happened before, and that is experiments with not only cannabis, but hemp is starting on a low level. So that's just one sign of things moving in this direction. And there's, now marijuana companies even operating inside the United States that trade on the stock exchanges.
Well, also, too, when you have so many governments running up massive debts and deficits, marijuana for the states that have legalized it has proved to be a huge economic boom.
Oh, yeah, it's just like casinos. One by one, I think the number is 3/4 of the states in the United States now have legalized casinos of some sort or another. So it's all driven by revenue and need. You got the lottery first, then you got the casinos. A natural move into other such industries makes sense. Now, the marijuana stocks are interesting because they've also, been going sideways, really since February. And, for instance, Canopy Growth, is trading in a very narrow range now, with resistance around 45 and support around 40. And as long as the stock market is not dropping, and this week's rally pushes that off, these stocks are poised to break out. And so there's an interesting situation developing in them.
Mike, thank you so much for chatting with us.
Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you want to contact Mike, you can email us at info@HowStreet.com. You're listening to HowStreet.com Radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.